Hi there, and welcome to another edition of the Energy Action Market Wrap, where we let you know what's happened in the energy market in the past week. My name is Andy Young, and I'm the General Manager of Business Services here at Energy Action. Well, after a rally that we've seen in the last few weeks, the electricity market actually dipped lower in all NEM states over the past week. And this has occurred on the back of an increase of COVID-19 cases, particularly in Victoria, and the surge in the risk of extending social distancing and continuing economic lockdown. Now, the major decline was actually seen in the calendar 2021 year prices, which is illustrating that the market attention is being on nearer term risk rather than longer term risk, and focusing on the extended economic lockdown and subsequently lower demand for energy. Calendar year 2022 and 2023 remained relatively stable with a modest decline, but the biggest declines, however, were seen in New South Wales, followed by Victoria. The South Australian market actually just mimics the Victorian market at the moment. Queensland remains pretty stable and the cheapest market for electricity at the moment. We've seen some incredibly low prices in the past week, particularly for Queensland customers. The underlying commodity prices for coal and gas are linked to international demand, and this is important because it affects the short-run marginal cost of production for generators and subsequently their bidding behaviour in the market. We see these latest movements in the past week purely as buying opportunities as a result. The Western Australian market has also dipped lower in the past week, and this is primarily due to general market sentiment, but also regulatory change, which allowed more competition to be introduced into various private and public networks, and which was noted in previous market wraps. Now, larger scale groups are actually in a pretty strong bargaining position when it comes to negotiating their electricity prices, either direct through brokers or direct through retailers. Now, what this means is that the deals that groups can get may actually be better than those that can be privately negotiated. What we want to do is we want to offer this benefit to smaller customers as well. So by bringing smaller customers together into a buying group, this may unlock some of the savings that they may not otherwise see. So if this is something that interests you, why don't you go and check it out on bill-buster.com.au, where you can register your interest and see how forming a buying group for small business can work in your favour. Well, as for gas, the current market represents a strong buying opportunity for anybody who hasn't secured a forward gas contract. Prices for gas are significantly lower compared to those that were seen in 2019. And as expected, contract prices for 2021 and 2022 remain subdued. However, prices begin to rise again from 2023. And this is mainly due to lower trading volume for longer dated contracts, but also because of the expectation of demand returning, at least from then. Current market conditions are caused by lower than anticipated demand for gas and also increased supply. So right now is the right time to buy, to secure cheap gas contracts, especially for 2021 and 2022. Overall, we expect the current prices to consolidate at current levels for the domestic gas market following the recent plunge in demand. In the certificates market, LGCs are consolidating at current levels following a recent rise of $4 a certificate, and that's trading at around about $38. Now, the futures prices for LGCs are $39 for 2021 certificates, $31 for 2022 certificates, and $21 for 2023 certificates. As we've recently seen in the LGC market, prices can be quite volatile and subject to any news on regulatory changes. VEECs are currently trading at $31 a certificate, while ESCIs are currently trading at $25 a certificate. Now, in the news this week, a $650 million power station project in South Australia that will utilise gas and solar power to deliver 422 megawatts of dispatchable power into the electricity grid has been given the green light by the state government. With construction to begin next year, the station is to be built on farmland at Tepeko, about 60 kilometres east of Adelaide, and will be the third largest power station in South Australia, behind AGL's Torrens Island Power Station and also behind Engie's Pelican Point Power Station. Also in South Australia, household solar panels could be turned on and off under state government instructions in a bid to avert statewide blackouts, predicted as early as this spring. The unprecedented move is being triggered by concerns from the National Energy Market Operator that South Australia's world-leading take-up of solar panels is making the grid unstable. This has prompted the state government to intervene to allow it to switch on and off household power to stabilise the grid. The measure would shore up stability of the grid and to help avoid mass blackouts, but would cut revenue earned by households feeding electricity back into the grid. The report says that the solar panel systems can fail in response to sudden changes in the grid's operation, and concerns are raised that even further because AEMO predicts household solar panels in South Australia could provide 100% of the state's energy needs within the next few years. Well, that's it for this week. Stay safe and cheers for now.